During the 2010 Vermont Captive Insurance Association Conference, Gary Osborne, president of USA Risk Group, answered some frequently asked questions about risk retention groups and provided some insight into recent developments with this very popular alternative risk structure. First, Gary gave us a little bit about the Act's background and history.
The Liability Risk Retention Act was first actually called the Product Liability Act and was passed in 1981. It was amended in 1986 to be the Liability Risk Retention Act, and since then, in the last 24 years, we're now up to over 200 active risk retention groups, and the law basically allows you to form as a risk retention group in one state and then operate in all other 50 states under the jurisdiction of your one domiciliary state.
There is often some confusion around what kind of business can be written in a risk retention group. In this section, Gary answers the questions about what coverages can and can't be written.
One of the major factors to consider here is that the risk retention groups are only allowed to write liability business. Now, the definition of liability in the Act is broader than the general understanding the public has of liability. So for instance, contractual liability is a much broader availability of coverage than you normally see in the marketplace. But we cannot do property, personal lines, workers' comp or healthcare. So there's a move afoot right now to try and expand the Act to allow us to do property insurance as well. But as of right now, it is liability insurance, so the most predominant coverages we're seeing are medical malpractice, auto liability excluding the physical damage, general liability and contractual liability.
It's not unusual to see a disconnect between how a state applies the Federal Risk Retention Group law and how it was meant to be. In this section, Gary describes some of those disconnects and goes through the typical licensing process for a risk retention group.
You have to apply to the chosen state. The most common currently are probably Vermont, South Carolina, Hawaii, and Kentucky. You apply to that state, submit your business plan supported with actuarial projections, and go through a review process. And upon that, if they give you a license, you then have to send out a copy of that application to every other state you wish to do business in. That process is supposed to be file and use. The reality is somewhat different. In fact, it is so different, the GAO has just agreed to do a study on the overreaching of other states onto these registration processes. California, for instance, imposes a 60-day waiting period, which is not permitted under the Federal Act, but most companies tend to go along with that because it's far easier to deal with a 60-day waiting period than to take California on in court. There are other examples, but that's probably the most egregious.
Risk retention groups have a pretty robust reporting regime, and Gary in this section describes those reporting requirements.
A risk retention group is required to file with its domiciliary state quarterly on the NAIC Yellow Peril, as we call it, the annual statement form and the quarterly statement form. They are due every quarter. That's February 28th, then it's May 15th, August 15th, and November 15th. Those are the major filing dates. The state also will then require an annual audit. Most of that states, that's either June 1st or June 30th, and an annual actuarial opinion. The opinion's filed February 28th, and then the actual detail of that opinion is due June 30th. These are the major reports. You're also going to deal with conflict of interest statements and a few other requirements, but these are the major reports. And the critical factor to remember here is anything you file with the domiciliary state must also be filed with every other state in which you're operating. The second part of the reporting is premium tax filings. Almost all RRGs are under either premium tax or surplus line tax, and so you file those forms, again, mostly quarterly in every state in which you're doing business.
A knowledgeable board of directors and good overall management is critical to the success of any business. Here, Gary describes why it's particularly important for a risk retention group.
The corporate governance question for RRGs came up in 2006, I believe, when the GAO did a study on how successful had the Liability Risk Retention Act been in influencing the insurance industry. It came out that they felt that there was not enough corporate governance then, that the boards were not perhaps taking their job as seriously as they should. So there's been a step up in that interest to say we need the board to be more active in looking at investment policies, underwriting decisions, claims decisions. So there's been a major step up in the governance. And so it's a very critical factor now, especially if you're a startup risk retention group. You're going to have to demonstrate to your domiciliary state that your board members have the experience and knowledge to make a successful board, and that the RRG will be able to rely upon the expertise of its service providers and its board members. The NAIC has also taken steps to improve that by passing certain new corporate governance standards, including independent directors requirements and extra requirements on the external auditors.
Finally, Gary talks a little bit about the emerging trends legislatively and operationally for risk retention groups.
The most important legislative issue for risk retention groups right now is the attempt to expand it to include property. This actually started back just after September 11 in 2001, when the property market hardened severely. There were two very large risk retention groups, Housing Authority and United Educators, that are very dominant players in their market, and they feel that it would be a big enhancement for their operations to be able to offer one-stop shopping for their customers. So currently they cannot offer property coverages, and you think of housing authorities and colleges, property is a big component of the risk. So they led the charge, and unfortunately it stalled, but more recently, after again the hurricanes and other issues, and the attempt to expand the governance issues, the risk retention community has again sought to get that expansion of the Act to include property. The other important area going on right now, operationally and legislatively, is that we have made a bigger effort and have succeeded in getting Congress to ask the GEO to do a study on the overreaching of other states into the regulation of risk retention groups. So now the GEO is going to do a study to look at all these extra requirements, fees, and other issues that other states are doing to RRGs trying to operate in all 50 states. And that is something the industry has been looking forward to, because currently the only way to resolve issues with non-domiciliary states is through the court process, which is long, expensive, and not the best solution for us.
USA Risk Group is the world's largest independent captive manager, and we have one of the largest portfolios of risk retention groups under management. We're 100% focused on achieving the best possible results for our clients and are completely free of conflicts of interest. And that's why you should be calling USA Risk Group to help with establishing your risk retention group program or any other alternative risk program that you might have in mind. You can reach us at 1-800-USA-RISK or check out our website at usarisk.com.